Welcome. On our fourth episode, we're joined by Ben Bush, Head of Precious Metals Market Making, and Patrick Seymour, Co-Head of Metals Market Making, to discuss the precious metals markets, which has certainly been dominating the headlines recently. Just as a quick disclaimer, we want to be clear that we're focusing specifically on the markets and are not intending to comment on politics. Ben, I think it's the question everybody's thinking right now. How are the developments in the Middle East impacting precious metals markets?
Thanks, Venus. Yes, I think, you have to look at the last 4 years, really, and given the amount of geopolitical tensions we've seen in the world, which really ultimately started during the Russia-Ukraine conflict. And in that time, we've seen precious metals, specifically gold, move 200% in terms of its price, and silver 400%. So a huge impact. And in terms of Dubai specifically, we've seen between 20 and 30% of the total physical metals trade through Dubai. So it has a huge impact in that region and on supply and demand chains.
If you look at gold as for want of a better phrase, a safe haven in terms of diversifying portfolios, then clearly that money comes in and out of the markets along with political events, along with when markets get extended in other parts of people's portfolios. Gold is certainly seen as a hedge, and silver more so now than perhaps it previously has been. That's been a change in the market. In terms of the retail investors, then the US administration change at the start of 25 certainly saw a change in money flows coming into the space, whether that was in ETFs, which we'll touch on a bit later, or just coming into investment portfolios.
Yeah, I think absolutely. I mean, when you look at the tariffs that have been implemented, when you look at the export bans, when you look at all the different dynamics around the world globally, these are all having huge impacts on the supply and demand chains. And I think, for me, this isn't going away. If anything, it's only going to ramp up. And, you add in the recent conflict in the Middle East that we spoke about on the first point, that's only going to increase the pressure on these chains.
Yeah, I think yeah, absolutely. I think it is worth noting though that gold's not actually up this week, so I think it was an obvious hedge for people. The tensions have been rising. Everyone's seen that. So the first move actually has been to reduce risk. So in a long market like gold was, where people were probably using it as a hedge, it's interesting that the first move hasn't actually been particularly volatile to the upside. So, and I think it's something we've seen across the rest of the investment space is risk reduction. That's been the big theme of this week.
And to your point, actually, Paddy, that ETF space has been such a strong driver of the price. To see 20 tons of gold actually leave the ETF this week since the beginning of the conflict just shows actually that the safe haven bid isn't necessarily true to its name in that sense of the word. This risk reduction across the board is actually a stronger force in the market right now.
I know that we've just slightly touched on ETFs and retail investors. It feels a little bit more evident in the precious metal space. Could you give us a bit of insight there, please?
Yeah, look, absolutely. I mean, they're probably one of the key drivers of the market, along with the central bank flows we've seen over the past 5 years. The central bank flows are very well advertised in a lot of commentaries, and the ETFs as well. People are now starting to realise the sort of impact those have had on the market, because they're obviously something that necessarily aren't so well talked about until today. And now, if you look at Asia and you look at India, if you look at the Western world, those ETFs combined have grown significantly from 150 billion to 550 billion in the last 5 years. So a huge amount of money in a relatively small market. Combine that with the central banks, where you've seen the increase in gold holdings significantly. The notional value of those holdings now across all central banks is 5 trillion compared to US Treasuries only sitting at 4 trillion. So that highlights where the risk has moved in people's portfolios and the value of what gold brings to that.
Yeah, the volatility in the market is driving decision making right now, and that includes reducing some of the hedges for portfolios, if that's what the gold and silver holdings were. And we're also seeing even central banks start to. There was a story about the Polish government.
Yeah, absolutely. We haven't really seen any on that side of the fence for a very long time about discharging some of these gold holdings they have. But actually, the Polish bank talked about maybe using it towards some of their defence spending. And the gold price actually reacted to that very quickly. And, in a market that has been built upon these two key drivers, seeing two stories like that, that could be where we see the risk reduction in these markets. And that's going to drive the price, on the short term, potentially lower.
You've just mentioned silver. So silver saw extreme price highs in February. What was driving that volatility?
The volatility was driven by the events playing out in the markets. Silver has, and always has had, a bit of an identity crisis. Is it a precious metal? Is it a proxy for gold? Do you represent your gold view through silver? And there's certainly an element of that. Gold went first. If we take the open interest peak that we saw from the CTA, or flow-driven, price-driven money in the markets, they peaked actually in October last year. So October 2025. The gold holdings in the CTA money was about 160,000 lots of open interest, but the price was already 4,300. Where in silver, that peaked at the same time at around 70,000 lots, but the price is only $53. So you can see that that investors came into the market to try and represent a view, and an amount of money in silver was probably to do with that. But silver has a lot of industrial uses as well. Al touched on the electrification story driving copper last week. Certainly, silver is a hugely important mineral for electrification. Also, it's widely used in solar panels and has other industrial uses. So, is it an industrial? Is it a gold proxy? And that's a question that will forever be part of silver's makeup.
And the silver market, we must remember, is actually even smaller than the gold market. So the flows into that, can move this price a long way. Some people have said to me recently, is silver the new meme coin? So, and you can see with the price moves why people might think that, but it is ultimately quite a small market, but it has a lot of different uses, as you said, in the industrial world as well. So if you've got both those two forces pulling on it, from a safe haven proxy or from an industrial point of view in a small market, which is under supply constraint, you are going to have these types of moves.
Yeah, and whilst the demand is very dynamic, especially in the precious markets with the current climate, the supply response is not dynamic, or certainly not as dynamic as the demand. So, in copper, things like copper concentrates and zinc concentrates, when you're mining for these assets, then a byproduct of those are things like gold and silver, as well as a wealth of other minerals. So they take time. You can't suddenly produce more silver, so the supply response is static to a large degree.
Ben, last week we spoke about locational premiums in alloy and copper markets due to tariffs. Are you seeing the same happen in precious metals markets?
Yes, absolutely. I mean, in the last 5 years, we've seen these premiums move significantly in these different locations. And, India last year, we saw silver at $3.50 an ounce premium over the spot price offshore, and then $11 onshore, which is extreme, obviously, volatility in that space. Compared to Hong Kong this week, we've seen a dollar per ounce premium on silver. So that's still happening. It's maybe not quite as extreme as it was at the back end of last year, but those premiums are significant. And, to Paddy's point about moving metal around as well, we've actually started to see people flying silver a lot more than they used to. I mean, traditionally on the ship, now flying it just goes to show the premiums have moved to that level now. And I think we're only going to see a continuation of that with the Middle East disruption. A lot of metal, as I pointed out, goes through that hub. So that's only going to increase these locational premiums, I think, in the foreseeable future.
Yeah, I guess that is a supply response, in terms of timing. But the supply chain stress is only going to grow. So risk management around that is also only going to become more important. Whether it's sulfuric acid going out to the Middle East, into Africa to help with copper concentrate mining, or urea used in fertilizer, also trapped in the supply chain. We're only at the start. We're only at the inception stage of the supply chain disruption, and it's similar in a similar way to COVID. Things played out for longer than people probably anticipated, because once the supply chain is disrupted, it takes time to sort these out. So, or find new ways of movement, or new routes for transportation. So, risk management, keep touching on volatility. they're all super important, and volatility is very hard to manage, and we have a lot of it.
And do you guys provide much data on this?
Yeah, certainly. In the same way that we provide the data in the base metal space through Neon Insights, we have real-time data that updates automatically daily. And the most interesting part, again, that we spoke about last week was that we've gained real traction from with our client base is the net spec components, which really tracks the flows of money into the space. So whether it's copper or aluminium or silver, you can see whether the money is coming in on a fast, medium, or slow basis. So the fast money can be in and out of the market quite quickly, and then the slow money tends to be more sticky, tends to stay in the markets for longer. But that's a really powerful tool for investors, for traders to see and get a real sense in real time of money flows coming in and out of the market.
And for me, Paddy, actually, that's the most interesting point, because the market is very clean here. By looking at our data, it shows it is, in comparison to where the peaks of the price were, we're incredibly clean, but we are only $400 off that gold high.
Hmm.
So I think that tells you everything you need to know about the floor and the price of these metals and where it's moved to. And potentially what we could see next is, if that starts to build that speculative position, we could, push through through those all-time highs.
Yeah, that's fair. That's a great point. And silver has only about 4,000 lots of open interest in that sort of CTA modeling type money. So that is really clean. From a high of 70, then to be only 4,000 lots, and the price is still above $80, which, if we hadn't printed the high we made, that would have been very high. It just shows you, yeah. So the longer the stress on the supply chains carry on, I guess the more you can expect the flows to be pushed around the world in these sort of diversified portfolio products. But the stress in the supply chain is real, and we're probably only at the start of that.
And how do you provide access and liquidity to this market?
Yeah, well, look, we've got a great platform, as Paddy touched on, but also from an execution point of view, we have a full suite of products which we use 24/5. And in these markets where they are extreme stresses, we like to think we've got a global team that manages a decent platform, throughout that 24/5 coverage.
Yeah, and with the current events playing out at different times of the day, depending on where you sit, and night, that to have access to that, or to provide access for that, is really important, because when certain markets are closed, the precious offering is not. So to be able to move risk around in real time and 24 hours a day is very important right now.
Very
Great.
good.
Thank you so much. That's been really insightful. For those interested in more of our insights, the team shares regular commentary on the global Marex Metals Neon channel. You can also find in-depth market analytics from Dr. Guy Wolf on his channel, including speculative positioning estimates, risk premium analysis, Nanalytics insights, detailed spreads reports, and more. Links to both are in the caption above. In our next episode, we'll be discussing FCMs with our global head of OTC clearing sales, John Fruin. We look forward to seeing you then.